Welcome to Deal Maker Show with Sarah and Ira. Say hi, Sarah.
Hi.
Hello, everybody. So in this episode, we will be discussing investment programs, starting in Insight Loans, DSCR, All-in-Ones, and Reno Loans. And here we are hitting in the first conversation and topic that some viewers requested. Sarah, let's talk about the Insight Loan program, and let's talk the variations with a conventional loan and an FHA, and why only conventional loans are used for those people that are interested in investments.
So FHA requirement is for the borrower to live in home for 1 year, minimum of 1 year, before they make it an investment property. So that's their FHA requirement, or any other government loans requirement.
Okay, let me cut in on that. So then say you're a first-time investor and you want to buy your first-time property, you can buy it, move in it with this kind of loan,
For 1
fix
year.
it, and then after a year you can sell it and not get penalized or in trouble or anything. You're following guidelines, right? Yeah?
On investment property?
Yes.
Yes, you can, on investment property, when you purchase an investment property, you can fix it, you can rent it, and sell it later in the future, and you'll never be penalized for anything.
Now, the Insight Loan can be on a first-time home buyer as an FHA as long as they live there for a year and then refinance and turn it into a conventional, or leave it be if they're planning on moving.
They don't have to refinance, no. They can live in it for 1 year as a primary resident on FHA. Required FHA down payments of 3.5%. A lot of people like to do that, especially when they're buying their first home. And after a year, they can just rent it. They don't have to refinance.
Nice.
And they can move on and buy another house.
That is really good to know for the people that are interested in starting their own portfolio. You can start with that. And as Sarah already explained to us, we don't necessarily have to refinance after the 1 year. Okay. Give us a little bit more breakdown on the difference of this type of product when it comes to convention for a person that is not doing a first-time home buyer. They're doing it specifically for investment.
So for investment property, conventional loan offer ability to loan money for the investment property. The requirement is minimum 15% down payment. And there's other requirement on the income and the reserve side. But it's basically, we can also go and when we do the appraisal, we can see how much the property will be appraised for, how much will be rented for, and we can use that toward the qualification also. So that makes a lot easier for borrowers to be able to buy investment properties, and especially if they don't make a lot of money. The requirement is 15% down.
Now, is that always the minimum down payment?
Minimum for investment property is a 15%
That's
down.
really good to know, because I've heard of other products that they have a minimum of like 20 or sometimes even 40%.
Yes, it's 15% down, a minimum for investment property on investment, down payment on investment. But a lot of investors, they go with the 20% down, because when you're buying as investment property, you have to see how much that property will rent for and how much your mortgage payment will be. And if it's the mortgage payment will be a lot more than the rent or close to, it would not make sense to buy it as investment properties. And when you go 15% down, your interest rate will be a little bit higher than a 20% down, and you will have a mortgage insurance on that one. On 15.
So at the end of the day, a larger down payment does help.
Does help to lower the monthly payment, to make more sense for investors to be able to purchase that property and rent it.
Okay. So for the investors that have questions on buy and hold, this would be a really good program to have. And we can definitely go in more and more detailed, and we can make another show if you guys request some more information on that.
And we always, we go side by side, you and I, and you will check for us from the beginning how much that property would rent for and how much the monthly payment, and you will be able to, you give them the insight of it doesn't make sense also or not.
Okay.
Right? Give them your advice and experience on how investment properties work.
Now, let's pair up a little bit on the Insight Loan conventional loan side of it and the DSCR loan. when you kind of compare that one?
DSCR loan, it's basically, there's some programs or some investors we can go with. They do 15% down, as low as 15% down. And the nice thing about that program is, like, if you don't have enough money, or like we see a lot of self-employed, they write a lot of their expense on their tax returns, and or someone is like just living on, whatever situation they have with their income, they don't need to look at income. That program, it just required how much the property will be rent for and how much the mortgage payment will be on that property. No income document is required.
So say this one is for somebody that has been working but has had a tough, say, year. Their income tax does not reflect anything or so on?
They will never ask for tax returns, yes.
Nice.
So no income documents are required on the program. They will look at the rent compared to the mortgage payment on that program. That's all.
Okay, so then what type of documents does this individual need to submit? Briefly, though, because I think it's a very interesting program for especially what's going on right now, that say people get injured and they're waiting for a settlement or something. They can use that settlement as a major investment down payment.
Yes.
I like that.
So the only documents they're going to require from them, it's first we do the credit report. We need the credit report because the score will play a big part of what is the minimum down payment we can go with.
What's the credit score required?
Of course, the higher the better. Anything above 700, we can go with 15% down. But if it's lower, it's required to go with 20-25% down and more reserve when the score is lower than 700. That's one thing they take a look at. The other thing is, like, when they found the property, we just need we will order an appraisal. And we just need their bank statements for showing the money that's sitting in the bank for the down payment, closing costs, and reserve. That's all.
That's a very, very good loan, and if you ask me. Let's break it down. What does it stand for? DSCR.
Debt Service Coverage Ratio.
Debt Service Cover Ratio and Insight Loan on a conventional side are very, very similar in the way that you can use them for investment property purchases. But better, for lack of a better term, would be the debt service credit ratio type of loan for anybody asking. Feel free to ask Sarah. Again, she's an amazing loan officer. Now, you mentioned something also that you have an all-in-one loan.
It's a program created by my company. All-in-one, it's a program. It's a first lien on a purchase, or even, if people want to use it for refinance. It's a first lien HELOC.
Okay.
We all know HELOC, it's usually a second lien that we take the equity on the current property we own, as if it was a primary or second home or investment home, and we use that small equity that we have in our property, and it's going to be a second lien. But with this program, it's a first lien. And people, they can use it when they want to purchase a home, or even they can use it when refinance. The nice thing about all-in-one, it's created to pay principal before interest. And that loan, if you do it the right way, you will be able to pay your mortgage within 10 years.
Now, you mentioned is very similar to a HELOC. For people that don't know, HELOC is a home equity line of credit, which has a tendency of being very low in interest because you're putting your house as the actual equity. And you mentioned that this all-in-one is even better as far as the risk for the bank.
You can use it as a first lien.
Explain the difference between a first lien and a second lien for those
first lien. When we do FHA conventional loan, when you buy your primary residence, the big loan you do, it's the first lien.
In order to be the actual mortgage owner, you own a first lien. So when you go to title and you close and fund, that's what we're talking about. You're a mortgage owner, not necessarily a homeowner. You're a mortgage owner, and that's your first lien. Then the second lien is when you take a loan out on that.
When you have equity on your home.
Okay.
So after a few years, you build equity on your home, you will be able to take that equity as they call it second lien HELOC. And the HELOC second lien, it's the way it's set up, it's open-ended. So basically you take the loan, you have certain years, depends on each program and each company, what the requirement for them. But like, for example, right now we have it. It's good for 5 years that even if you pay it off after a year, you can pull the money back again, pay it, pull the money back again, So for 5 years, it's like you can pay the loan off, but it's still going to be open, and you can use the money again if you need it later. It's good for 5 years like that.
That's why it's called the home line of credit for 5 years.
Is open for 5 years to be able to pay it off and pull and use the money again. That's what the HELOC is.
And it kind of correlates and is very similar to the all-in-one.
But it's a first lien. So when you're purchasing the home and you need that big chunk of money to
repair the house and whatever.
To purchase the home, and the requirement will be very similar to a conventional loan. And the nice thing about the program, it's open for 30 years.
Oh, nice.
On investment property. Of course, for the first 10 years, you have access to the equity for 99%.
Ooh.
After the 10 years, that percentage will go down.
Okay, wait. So you have an all-in-one. That's how you buy that property. That was your first lien. Then you can pull equity on it right off the bat to fix the house for a period of 10 years.
When you're building that equity, you still will have access to it anytime you want it, without going back to the lender, without anyone checking your income, without anyone checking your credit, without anyone seeing if you qualify for the loan or not.
How do you pull that money out? Who physically?
You will have, as soon as you close on the loan, we will be able to open a checking account for you that connected to the loan. You will have a credit card, not a credit card, debit card with you. Same thing that you use a credit card with your bank account you have right now. Mm-hmm. Let's say you go to the gas station, you want to put gas in your card. You can use that card, and we'll pull the equity from that card, from your loan to the card right away.
Wow, that kind of sounds like the interest rate only loans.
Even on an interest rate only loans, it does not work like that. That program, it's because it's set up as a HELOC style. So it give you the access to the equity anytime you want on the property. So it's
like a draw.
It's like,
do you ever have to pay it back, or is that okay?
So let's say you purchase a home and your loan amount is $200,000. After 3-4 years, that loan amount went down to $150,000. Mm-hmm. You still have access to that $50,000 anytime you want it. You're right now at $150,000, so you're gonna pay interest on the $150,000. It always will work like you're paying interest on the remaining balance. But let's say after 3-4 years, you want to pull $20,000 to repair the home, to use it for anything else you want. Now your loan will be $170,000.
Does it work the same if you buy a property that appraised, and I like that we're using numbers, so let's round it up to $500,000. It appraised at $500,000 at the time of purchase. You go for the all-in-one, is your first lien on it. But it appraised up to okay, now, so then that already answered my question.
Your property you purchased for $500,000, you put a 20% down because an investment will require 20% down.
But it's messed up. You still need to fix it. Right?
You will start with $400,000 as a loan amount. You're not going to be able to go pull that 20% right away, because you're stuck at $400,000. But anything under when you start paying off the loan, anything under $400,000, you will be able to go and pull that money to go back up to $400,000.
So this only works when the actual property has been appraised for it, because there's a huge difference when you go for, say, a hard money loan and the draws for fixing and repairing the house. So for there, just really basic and briefly, because some of us that may be comparing it in our heads to that. So we're talking the all-in-one loan with hard money loan. In hard money loan, say you buy a $400,000 property, but they lend you up to $500,000. Not necessarily the house at the moment appraised for $500,000, but they're already lended to you. This does not work like that.
This one is similar like to conventional. You're purchasing the home for $500,000, you're putting 20% down. Your loan amount is $400,000. It's the same thing here. Your loan amount is $400. On a conventional, you're making the mortgage payment. You go down to on the principal to $350.
Okay.
You want to pull the equity out of that property. What you have to do with conventional loan, you have to go refinance and do a cash out refinance, or you go and create a second lien and do a home equity line of credit. So they will have to check your credit again. They will have to check your income again. If you have a lot of debt liabilities in your credit, that will affect how much you're going to qualify for the HELOC, for the home equity line of credit as a second loan, or it's going to affect your cash out refinance.
So you have to maintain your status as far as the good credit on a HELOC, but not necessarily on the all-in-one.
If you're on a conventional and you want to pull a HELOC, but an all-in-one, you start the loan at $400, you're paid down to $350. You want some equity from that property.
Okay.
You just go to the account online, you can, and transfer the money to your bank account. Within minutes, will come to your account. No one will need to rerun your credit or do a cash out refinance. A cash out refinance process takes about 3 weeks. It's like run credit and go to underwriting and check income documents and all of that. No one needs to do that. You have that $50,000 equity and you can pull it and use it. You can pay it off after, go pay that extra 50 you took after a week, after a month, after whatever the setup payment that will be for that.
So it's not necessarily a monthly payment. It's whatever you set up.
Will be a monthly payment for the actual loan amount. But when you take extra money, no one is going to tell you took $50,000 out of the account. You have to pay it right now, or you have to pay it after you don't have to pay it after a short period of time. You're just going to make your monthly payment increase by $50,000 because you do.
Now, let's say the mortgage gods have blessed you and you bought the house and the loan at $500,000. You have that just by math alone, you have already $50,000 worth of liquid, therefore you can pull. If the real estate gods have blessed your property and in a year your property is worth now $700,000 for the lack of math, okay? And your loan balance is $450,000. Now, do you have $250,000 to pull out of that?
No.
If you do an appraisal or no? It's already said and done.
It's only said and done. You will have to start a new loan.
Okay, that is really good to know nonetheless, because you're still paying for getting a good $50,000 that is being revolved in the meantime, though. Okay.
But that program, it's made to pay it off in 10 years. So you will have equity, from the loan amount. You will be paying off faster than normal loan that takes 3 years. So that's why you will have that equity build on the loan.
Why is it paid faster? I'm sorry.
It's made to be able to pay principal before interest.
Ah.
So they calculate the principal before they calculate the interest for you.
All right. And the interest is what scares us all, as you may have already noticed, is the one that fluctuates up and down. So the fact that this loan somehow has been designed to pay the actual amount that is used to purchase the house, which is the principal, instead of the interest, it is such a great product. It is something that you definitely need to ask Sarah, once again, if you're interested in buying a house, because this is definitely a really, really, really good product. Now, you mentioned that it would be the principal before the interest. You do need to have preferably a 720 credit or higher in order to be privileged to getting a better interest rate. And then you mentioned something about it being a 43 debt to income ratio. And this is public information on any webpage. You go and you request all-in-one federal guidelines for this program.
It's in our company website, yes.
Okay. All right. And we already discussed that it's like very similar to the HELOC, but actually better. Now, let's talk, that kind of trickles down to another type of loan that it would be a renovations loan. And that is also a conventional program.
It's a FHA and conventional program, but FHA required you to live in the property for 1 year when you purchase it.
Okay.
As a primary resident. But for investors, if they want to buy an investment property but it needs some work, there is a renovation loan for them on a conventional side. And the renovation loan also is required, minimum down payment is 15%. And what the renovation loan you can do, it's you will have a contractor will go and you tell the contractor what the work you want to do on the property to improve it, and that will be added to the loan.
They submit their
quotes, and when we do an appraisal, we will do an appraisal. When we go under contract, we will do the appraisal and value the home with the work will be done.
So it's an assumption
of the work.
Appraisal. Okay.
Yes. Of course, they will do. They will send an inspector after to make sure that work has been done.
Okay.
As what we had it on the document, but we will appraise the home and give it a value after the work has been done. So that's a nice thing about that loan, because it's add more value to you're adding the value to the money that you will be paying. And we go with the 15% down from the purchase price, not from all the work will be done to the property.
So if you are a licensed contractor, you can definitely do your own work on this. Again, the inspector and appraiser will be checking your work, Mr. Contractor, and license.
Yep.
And it has to be according to standards. You cannot do a, say, $20,000 job and it looks like you spend $5,000. Okay, so this loan is not made for, I'm gonna stick it to them. No, you're not. Everything's gonna be reviewed. Everything needs to be up to standard, up to code, and so you better do your due diligence, Mr. Contractor.
But it's a great way. Sometimes like we get some investors, they are tight on money, and they find a property. It's a good investment property. It's gonna bring it's located in an area that there's a lot of renters there. The monthly payment will be good, the mortgage payment will be good, and the rent amount will be good for that for that property. But it might need some work. Might need some repairs. So, and if they are tight on money, they can use that program. It helps them to make that happen.
Let me ask you this. Can a Reno loan be used for a refinance? Because now they need money to...
Yes.
Yes? Okay, so it doesn't necessarily need to be a first-time home buyer. This is definitely for people that are in the investment world now, or you, as everybody should be, giving levies to your property, and then take this money out and use it to take care of your property.
Yep. Yeah.
You can
use it as a refinance.
So on this one, I noticed that we discussed 5 topics. We went for the inside loan, discussed both conventional and FHA, the amazing new program I just learned myself, the DSCR, the all-in-one, the Reno loans, and a little bit we touched in on the HELOC. So I noticed that we are getting a whole lot of questions. Our phones are ringing. Our internet is going off crazy. So we're going to do another show and break it down, because these are way too many questions, people, that I'm getting. So stay tuned for our next show where we go down into the details of the inside loan program, conventional, and the DSCR. And let us know what else you want to know about. Sarah, you're ready to say goodbye for today?
Yep. Well, goodbye, everyone.
Watch us. Be on the lookout for Deal Maker Show on YouTube. And this is, once again, Sarah, your amazing loan officer, and Ira, your licensed realtor. And we are tackling investment programs because we should all be looking to build our own portfolio.
That's right.
Any questions? Give us a call.
See you next time.
Bye.